Welcome, and thank you for joining us today. This is a family law software presentation on one topic and one topic only. That is going to be business income with family law software. So hopefully today we're going to answer the most common questions that you're going to have for the most common entities that your clients are going to have. Today's webinar is going to be hyper-focused. So we're going to talk about 1099 contractors. So those of your clients who are going to be essentially self-employed. We're going to talk about small businesses, especially. We're going to talk about individuals. So those individual sole proprietor businesses. We are also going to discuss partnerships. We're going to discuss LLCs, which are disregarded entities. And we're going to talk about S corporations. The one thing that we are not going to discuss today is going to be C corporations. So know that family law software is going to be able to handle those types of tax issues, but it's just outside the scope of today's presentation. Specifically, we are going to talk about common income and tax considerations for all of the entities above, again, except for the C corporation. So if you're here and you have a question and you're already itching to ask the question, what about salaries, bonuses, profits, draws, LLCs for real estate? We're going to answer all of those questions today. So we're going to get to those. So if you happen to have a question about that, we're going to get there. If you pop it in the chat, it might say, wait for just a couple more slides, or we can pop in a quick answer. And we are also going to be demonstrating, we're going to have a PowerPoint presentation, and then we're going to do a live demonstration within family law software. So a growing popular form of, say, employment or working is what is 1099 contractors. So if you have a client and they receive a 1099 for their work and services, that is for what is called non-employee compensation. They're not really an employee. They are self-employed. They are an independent contractor. Anybody can get a 1099. So if your client doesn't have a business, they're like, well, I don't have an LLC. I haven't filed any paperwork with the state, but I get this 1099. You don't have to have a business to have income that's reported on a 1099. It's done through a social security number, and their businesses are going to issue those anytime that they're using the services of someone after they've paid them $600 plus. So if your client's getting them, they're extremely common right now for lots of different reasons. Companies are using 1099 contractors a lot. There is no employee-employer relationship, so they're not going to be a part of benefit plans and 401k matching and health insurance plans and all of that stuff. That's not the type of things that you're going to see. And what's happening is that 1099, it is what it is. It's a gross number. That gross number is what we're looking for and what you're going to pop into family law software. There are no tax withholdings from that 1099. That's just all the money that they made, and they're going to have to pay taxes on those dollars that they made. So no one is going to be withholding for them. Sometimes people get really shocked by this. They may not have understood what being a 1099 means. They just kind of kept taking that money. And then sometimes they get a little bit of sticker shock when it comes to tax season. And the reason that sticker shock happens is because of the self-employment tax. Again, family law software, we're looking for that gross number because we are going to calculate the taxes. And so what happens when you possibly, maybe you're an attorney and you do contract work, or your clients, then when they receive that 1099, essentially, the self-employment tax is consisting of the Social Security and Medicare taxes for individuals that work for themselves. If you're a W-2 employee, you've seen your paycheck, it's this big dollar, and then at the end, that net income gets smaller and smaller because of taxes. And so how much is the self-employment tax? It's kind of high. So it's 15.3%. Why? It's a mix of Social Security and Medicare, and it's high because that self-employed person is paying taxes as though they are the employer and the employee. So if you've ever wondered why it's so high, it's why you're kind of paying the taxes that your employer would normally take care of versus what you as an employee pay. And so that's why you get that sticker shock of the 15.3. It's not all that bad because you're going to see when you look at your client's taxes, when you look at our tax calculations within family law software, they're going to get a credit for half of that amount that they pay. So you're going to see that. Who are self-employed individuals? Before I hand it over to Nancy, self-employed individuals, like we said, could be anyone. They are contractors. You may see this with your clients who are lower income. Maybe they provide janitorial services, but you could see this with really high income individuals who work for Harris, Lockheed Martin, they're government contractors, and they're easily bringing in, $300,000 on a 1099, and they haven't incorporated or done anything with that. They just take the 1099 and they eat the tax. So I'm going to pass it over to my colleague, Nancy Schaefer, and she is going to get us into family law software and show us the basic beginnings of a 1099 person who is self-employed, and then show us what that tax picture looks like.
Okay, so we're going to look at a self-employed person who is going to enter their income. So the first thing we're going to do is go to the income page, and I'm using Florida as an example here, but this would apply to any state. Your data entry may be a little different, but you'll have the same thing. So wherever your wages are, and it could be also duplicated in your support guideline page, you'll put in your wages, and then we have a box here. Is this self-employment income? So you will see here, I've got Jason and Janet. Jason gets $52,000 as a wage, and Janet has $25,000 per year that is self-employment income. So you'll see this checkbox here that my cursor is on. And that tells us that that's going to be self-employment income. So when I go to my reports, view edit taxes, let's look at Janet's column here. And in Janet's column, when we get down to taxes, here you will see that credit for 1/2 of the self-employment tax. And then in the taxes, you will see the self-employment tax reflected, and her total taxes are going to be higher, but she gets a credit for 1/2 of them. So that allows us to move around. So here's the adjustments for 1/2 of the self-employment tax. And then you will also see, sorry, I need to press that one. In the support guideline, in the guideline worksheet, we may have a note that will tell us that is self-employment income, and the taxes are going to reflect that. So here we see Janet's federal tax here excludes the self-employment tax, which we're going to pick up later. So you just want to be aware of that. Okay, so that's assuming Janet is just getting a 1099. She's not got a business with expenses. And we will talk about expenses shortly. Okay.
Okay, awesome. Thanks, Nancy. So again, that's how you would deal with a 1099 contractor. But today we're going to dive in a little deeper. And in family law software, when you go into your asset section, so remember, Nancy is using family law software cloud-based. She randomly picked the state of Florida. Your program may look a little different, but if you go to your asset section and you go to your business section, what you're going to see is when you enter a business, you'll be able to choose individual. And so that's going to be an unincorporated business or an LLC for tax purposes. And we're going to show you that help note when we get there. You have the option to choose partnership. So that's assuming that there's going to be multiple people within this business. And then S corporation, which again, we're going to go into detail. And last, you will be able to choose C corporation, but that will be outside of today's presentation. So the first data entry point that we did was assuming, again, your client works for government contracts, they receive a 1099, they have no expenses, that's the end of the story. It's very tempting for novice users or new users to say, well, my client is 1099, and so all I'm going to do is reduce their 1099 by their expenses and put that into family law software. That is wrong. So if your client receives a 1099, but they have expenses, or they're a business and they're receiving 1099s, what you're going to see, the buzzword when you look at their personal taxes, is they're going to file a Schedule C. They're going to have a P&L, so they're going to show profits and they're going to show losses, and that is going to be a different filing with the IRS. So if your client does that, this is very common for realtors. So your client's a realtor, they're paid as a 1099, but they have advertising expenses. They've got a fancy car that they use to move their clients around, or they just have a business with a lot of expenses. The data entry is going to be different. We're going to be moving into the business section of family law software. Again, we want the gross number in family law software because we are going to calculate the taxes. One of the double dips that you want to be careful of is if they are doing estimated taxes, you don't want to do a double dip on that. Family law software is going to calculate the taxes for you. So that's for a 1099 trade or business. But similar is going to be an LLC, or an LLC single member is another extremely common entity formation type. Does your client have an LLC? Great question. Ask your client. Does your client have tax documents? Great. You have to see them. I can't tell you how many times users will reach out to us with a question, and our follow-up is, are they an LLC? Are they 1099? Are they an S Corp? So you definitely need to look at those tax documents because all of this information is going to be there. If they are an LLC, they've registered with their state, they're a business. And they are disregarded entities. So all of the forms of businesses that we're talking about, all of this income is eventually flowing to their personal taxes every year. And so all of these dollars, even though it's an LLC, it's gonna eventually flow to their personal tax return. And you're still gonna see that 1040, and you're looking for that Schedule C. So the same thing is gonna happen with the LLC, the single member. And so this is a person, again, they own a business, they've incorporated. The tax picture may be a little different, obviously, because they are having that profit and loss and that self-employment. How do LLCs get paid? So I saw some of the questions popping in. Your clients may use different words for the same things. They might just say, I take money from the business. I take the net profit. I take a draw. I take a distribution. They call it a bonus. Whatever they call it, it's money coming out of the business. So don't get lost in the terminology that your client might use versus what you would see on the IRS website. So what is happening now? I'm going to pass it over to Nancy in just a moment. We're going to show you how to deal with an individual business that has income and expenses, or an LLC. It's going to be the same way. And in family law software, there's two ways to do this. If your client already did the math, they've got the bookkeeper, they've got the QuickBooks, you know what the money coming in is, you know what the expenses are, and you have a net number, you're going to see in family law software that default is to use net cash flow. Or you can do an income and expense worksheet. So I'm going to pass this back over to Nancy for that demonstration.
All right. Very good. I am taking over. And you will see now that I have my family law software file open, and I am going to talk then about the business interests. And I created multiple businesses in this sample file. This is Jason, business owner, versus Janet, independent contractor. So now let's look at some of these businesses. So I've got 7 businesses here. We're going to not do all of them right now. We're going to start with the independent contractor business that Janet has. So for Janet, she's got a very simple um, 1099, not a big business. We're just going to do the simple enter the net cash flow. I could just make it be the $25,000 we saw earlier as her 1099, but I just wanted to demonstrate that you can do it this way as well. The key here is to select the type of business. Select the type of business. So this is a drop-down box. In some states, it will be a default of individual, and you have to go in to change it. In my wonderful state of Illinois, we have a certain field in our financial affidavit that requires us to select the form of business. So it will not be a default here, but you have to select the form. So we're going to go into the more information, which is this green box with the 3 dots. In the desktop version, it'll say more information, more info, or more. And here I have my selection. I can enter the business income directly, or I can go to the calculated amount. So for this one, I didn't put in any expenses. It's just her income. So now let's go to Jason's non-sub S LLC. And that means it's going to be the LLC is a disregarded entity. It is not going to be a separate entity for taxes. So for tax purposes, it is taxed as an individual. And when I go into the more info, instead of putting in the directly entered expenses or cash flow, net cash flow, I'm going to use the expenses. And then it's going to give me that annual pre-tax cash flow. But when I click here, now I'm going to see my business and expense worksheet. Let's make sure everybody's muted. The gross revenues, I can call it whatever I want. Gross receipts, gross revenues, money in, income, whatever I want to call it. And I can add other lines. Sometimes I will add a line for cost of goods sold here, because on the tax return, that's where it appears. But then that would be a negative number. So let's say I had a cost of goods sold of $200 a month or $2,400. It's going to subtract that from my income. I don't have to use that. And it changes my net income as well. So let me just scroll all the way down. We're still in a positive cash flow, so let's leave it. And here I'm putting in my expenses. Now we have included lines for the most common expenses on people's tax returns. And you can pick this up from their tax return, as well as figuring out what form of entity they have and how it was worked before. So I put in all this stuff, and our friend Jason, business owner, is got a net profit for the year of $1,420. If I take out that cost of goods sold line, I'm going to just delete that, and that gives me a 3820 of value. Okay, and you can add more expenses if you need to, and have it will all be calculated for you. The key here is that when you're entering a business, The question is, how is the business treated for tax purposes? Which on this page is question 9, item 9 on the business more info page. And you have your choices that we went over before. And then at number 10, the question is this a pass-through business? This would be a pass-through business. Why is that important? We will get to this later, but we will talk about the qualified business income deduction, which allows Jason here as the business owner to take a deduction for the qualified business income expense. And if he was a lawyer or an accountant, we would have to check the second box that the business is a service business. Even though it's still a service business, for some reason, architects and some other service businesses don't count as service businesses to the IRS. They have better lobbyists than we do. And then we will look later at some of these other portions, but let's look at the calculation of the qualified business income deduction. So I am now in the QBID worksheet, and this is going to give us all of the businesses. So the first thing we're going to do is for each of the parties, we're going to look at what the qualified allowable percentage is going to be, and that's based on an income threshold. It phases out at a certain income threshold. So Janet's independent business has a 20% allowable pass-through. So she's going to get a credit deduction of $26.40 on her independent contractor business. Jason, in his sub S business, had a net profit of $38.20, and he gets to have 20% of that as a deduction. Okay, so now let's go back to the PowerPoint and look at some other types of businesses. Stop share. Okay.
So far, what we have discussed are individual businesses. But of course, it's usually not that simple. Sometimes you have multiple owners or partnerships. And so a partnership is obviously going to be a business relationship with multiple people. Each person is contributing to the business, and they share in these profits and or losses. And again, this income is flowing through to these business partners on their personal taxes. And so if you're an attorney and you keep on hearing us saying like flow through, what we mean is the business isn't getting taxed, and then the parties that are getting paid by the business are also getting taxed. It's just flowing through out of the business and into the personal taxes of the parties. And in family law software, there's a little twist on this. So we're going to send it back to Nancy so she can show us how to appropriately put in business partnership income into family law software.
Okay. Whoops. You have to stop share. Thank you. All right. So now let's go back to the program, and we're going to look at Jason's partnership or LLP interest that we have selected partnership as the form, and we're going to use the items of income and expense and have the software calculate net income from those. So we're going to go into the worksheet for income and expense for this partnership. Now, here's the trick. I told you before that you can pick up the income and expense from the tax return. For a partnership, you're going to be looking at their partnership return. The key there is the partnership return is going to reflect 100% of the income and expense. Maybe Jason is a 50% partner or a 30% partner or a 2% partner. So you have to do the math to translate those into the numbers here. So if it's only a 2% partnership interest, you may want to just use the summary form of entering the net cash flow. Whoops, this one. Enter the net cash flow that you'll pick up from the K1 or the partnership return, but essentially Jason's share from the K1. But if there may be a 50% partner and you want all the detail, especially if you're going to look later at adding some items back in to income for support purposes, and we'll talk about that. You may want to have the income and expense worksheet completed, but remember that you're only going to put in their partnership share on this one. Okay. All right, next.
All right, perfect. We have covered a lot so far. And so the next topic that we want to touch on is extremely common, is that when you have clients, they may own multiple pieces of real estate. One or more of those pieces of real estate may be held in an LLC. And so it's very common for us to see a family law software file that has 10 different LLCs because it has 10 different investment properties. So if you've ever had one of those cases, or even if it's just the one, it's very common to see this. It doesn't affect just high income cases. You can have parties that just have that one rental property and it is in an LLC. The client's very proud of it. They own a piece of real estate and they were smart enough to make an LLC. That is not helpful for taxation purposes because not all LLCs are created equal. And so just because you look at the online property website and you pull up the address and you see that it's an XYZ real estate corporation, it doesn't tell you a lot about how it was structured. So just because it's an LLC, it could be a partnership, it could be a C Corp, it could be an S Corp. It may qualify for QBID, the qualified business deduction. How do you find this out? You have to look at the taxes, or you have to look at the documentation for the LLC. And so the hiccup that we run into, especially for the attorneys, is sometimes you want your real estate to appear in a certain way. You want it to be in your asset section with real estate, and you want to keep your businesses separate. And so we really wanted to discuss this topic because when property is in an LLC, let's assume the purpose of that LLC for our demonstration purposes is to collect rental income and has expenses. And so because of that, the best practice that we're going to see is going to be to do this within the business section. And so you really want to have a business for the first property and the second property and the third property. We understand that you might want your documents and your court forms to look a certain way. And so I'm going to pass this one back to Nancy to discuss the real estate in family law software when it's an LLC holding that. And I'm going to pass that back to you, Nancy.
All right. So what we're going to look at here is I have entered in a couple of real estate LLCs, okay? But I've also entered in the real estate properties themselves, investment property 1, investment property 2. What I'm going to do here is I'm going to enter it in for my balance sheet as the asset if I want to show the real estate on my balance sheet. If I want to show the value of that real estate in the business asset, so if I'm going to have a valuation and look at it as a business value, then I don't need to enter the real estate at all. I can just enter the value into the real estate LLC. if I've done the asset as real estate, then I'm going to leave the value out of the sub S LLC so that we aren't double counting it. And I want to enter it in for income purposes, income and expense purposes, as a business, primarily so I can get the QBID deduction. So as real estate, let me go back here to the investment property. I'm going to go into more information, and I have entered in that this is rental income property. Okay. And so then if I said no, all of this stuff would go away. But when I say yes, it all comes back here. And I have entered in the gross rents. I've entered in who's going to get it. I've entered in the depreciation and the basic expenses. I entered those expenses here in real estate expenses, just like you would for the primary residence, for example. But for this purpose, we're only looking at these expenses as the cash flow in the real estate. So this is what would show up, for example, on the Schedule E if this was being done as rental real estate. But if we're doing it as a business, then instead of those expenses there, I would go into the business and let's go into, the business interest for investment property 1. All right, Jason's real estate 1. And when I go in here, I'm going to have my net cash flow because I've entered in the items of income and expense. So when I go to the income and expense worksheet, those very same items that I could have entered in the real estate, instead, I'm going to enter in here as a business, and it gives me the same dollars, but you're not going to do it both ways. You're going to pick which way. But this way, I have a qualified business income deduction. So now when I go to, let's go to the right one, Jason's real estate number 1, we have a 20% credit or deduction from income for 20% of the net profit of the pass-through income of that real estate. So here we're entitled to the QBID. So my opinion is the best way to do it, put the value of the real estate as an asset, put the expenses, the income and expense, as a business. And it should work out perfectly for you. Okay. Share. Take it away.
All right, awesome. So if you recall, in the beginning of the presentation, we were talking about that fun self-employment tax. What is going to happen is when a business gets larger, it doesn't even have to be that big. So for instance, once you hit maybe $100,000 coming in or more, you may get advice from a tax person that says your LLC, you should elect for an S corporation. It doesn't necessarily have to be an LLC. So we're just going to talk about S corporations. This doesn't happen by accident. So let's talk about what are S corporations. S corporations, again, you have income, you've got losses, you've got deductions, and you have shareholders. And again, that income is going, or the income or the losses are going to flow through to those parties on their personal tax return. But what's different is that income that flows through is going to be taxed at the individual income tax rates. This doesn't happen by accident. So again, when you're using family law software and you see that drop down and it says individual partnership and then it says S Corp, You have to specifically elect to be an S corp. It doesn't happen by default. Just because you have a business formation, it does not mean that it's an S corp. So you're going to be asking your client that question and looking for those documentations because they had to specifically elect for it. And so what happened, the tax picture is very different. So if you were to run, party A as an individual and then party B as an S corp, you're going to see that there's going to be wages that are paid to the owners or employees. So you have to run salary. There's going to be a W-2. And then that income is obviously subject to FICA. But then whatever's left over after reasonable salaries are paid, you got the income, the expenses, and reasonable salaries are paid, there's going to be profits. Your client might call it a bonus, a draw, a distribution. Again, your clients are going to use different words. They probably mean the same thing, maybe not. Obviously, you want to look into that. But that extra profit from the S Corp, that income is going to pass through again onto their personal taxes, onto their personal return. It makes a big difference. So I'm going to go back to Nancy. She's going to do the S Corp election and then talk about that W-2 salary and then that extra income that comes in as well.
Okay. So if you remember our Jason business owner, when we went to wages, we gave Jason $52,000 a year of wages. So now let's go into the business and we're going to look at his sub S LLC that is that the one I did it? Might have been this. So when I go into the wages or the income and expense, sorry, yes, you will see here that we've put his wages in as an expense. So essentially, the wages get deducted from the corporate income net profit. The gross receipts were 132. There's all of these other expenses, one of which is Jason's wages. Now you could divide it up into owner salary and employee salaries, as some balance sheets, some tax returns will do, but it's all wages. So in this case, it's only Jason. He's got $52,000 of wages, which will get carried over to his wage income, but is a deduction from net profit. So his net profit here is $59,960, and the $52,000 that he got as taxes. This $52,000 is going to go out as wages. He's paying FICA on that. FICA meaning Social Security, and also Medicare. But on the $59,960, he is not paying FICA or Medicare on that money. It's flowing through as business income. So when we go back to, for example, our budget report, you will see that Jason has his salary. Oh, and by the way, he's got a bonus we'll talk about later, if we have time. And then here is his partnership that is flowing through for additional income for him for support purposes and for tax purposes. So when I go to view edit taxes, that 52,000 shows up as wages, and then the business income shows up here. And it's not the number we just looked at because I have like a bunch of businesses in there and the program adds them up. But we're going to do one at a time. So that is how you treat the sub S wages and income. Okay.
All right, perfect. So the reason that choosing the correct entity formation is important, and obviously putting in the income, expenses, net cash flow into the program appropriately, is because family law software is always calculating taxes in the background. So that view edit tax screen is your best friend, especially if you feel like you're doing something off. You just go there, look at what the tax picture is, click on the help icons and see how those calculations happened. One of the huge changes that happened under the Tax Cut and Jobs Act of 2017 was something that's cool that we've been mentioning is QBID, qualified business income deduction. And so this didn't exist before then. And I'll say that it's complex. It's not something that is easy to jump into. But what it is that if you have a business, or you're an individual, if you have a qualified business with qualified business income, you can obtain a deduction up to 20% on that qualified business income from the entities that we just discussed. There's different limitations, like the type of business, and then how much money you have. So there's caps. This can apply to all of the businesses that we've discussed today. You don't have to be an expert on this. We're not asking you to be. What we've said over and over again is that if you look at your client's taxes, you're going to see this on their taxes. It has multiple data points in family law software for us to properly calculate the QBID. So if your client has a business and you go to that more info screen, we're going to show you the extra data points that you need to make sure that you click. Nancy touched on a few of them, and we're going to go over a few more of those data points to make sure that we calculate this appropriately for your case. So I'm going to send this back to Nancy.
Okay. So as Anna said, there are limitations and there are certain structures to the QBID. So let me go back into the business. Let's go into that sub S that we were just looking at for Jason. The LLC sub S. No, I'm sorry. One with his wages here. This one, the partnership. And I'm going to go in here and go into the calculation of the qualified business income deduction in a minute. But what you're going to see for us is at question 9, how is the business treated for tax purposes? This is what's going to set it up as a potential QBID deduction. Then, is it a pass-through business? And we're going to say yes. A C corporation is not a pass-through business. That's what we're not talking about today, but I'm just pointing it out. And then there are certain service businesses, and you'd have to look at our help note or check the IRS website for what that is. And our help note will tell you lawyers, doctors, nurses, people work in financial services are considered service business. Interestingly enough, there are some which are not. Engineering and architecture services are not service businesses. I thought they were, but for our purposes, they're not. Then we want to look at what is the W-2 income that's going to the party or parties. So sometimes there's a limitation based on that. And then we also want to know if there are qualifying capital assets and what the cost was. So when I go into the calculation of the QBI, let's go to this one that had the wages. So here's Janet's business. Here's the non-sub S business. And here's our sub S business. So you will see that we first look at what is the pass-through income. That's the total net profit or loss. If it's a loss, then there's no deduction because you can't take a percentage of a negative. And so how much of it is allowed? In this case, it's the whole thing. Up at the top, we have a calculation for the allowable percentage or allowable business deduction. So in this case, it's 100%. So it's whatever the number is for our friend Jason here. We then look at their W-2 income, take 25% of it, and then plus 2.5% of the capital if there was a capital investment, and then come up with a allowable amount. So in this case, the allowable amount is 26,000, and he gets a deduction of his 20% of the allowable deduction. Sometimes these numbers, if for example, his W-2 income was 152, there may be other limitations that would hit. So these are the things that we're looking at. It's all being done in the background. You don't have to actually know it, but you can double check the information to make sure that you understand it, and liberally use our help notes. So we will explain it all for you. And that way, when the other side says, I disagree with your numbers, or you say, I disagree with your numbers, you will be able to know that you are correct. Okay.
All right, awesome. Thank you, Nancy. I always I always tell users, if you click on those blue bubbles, they just have critical information. There's so many hyperlinks within family law software, and we explain our calculations. And at that point, you have the backing to help back up your numbers, or you might want to make changes. So definitely check out those help notes and reach out to us when necessary. All right. The last topic that we are going to cover is what I am calling bad deductions. When you have a business, there's lots of things that your clients are going to do. What they report to the IRS could be very different from what's going to fly in front of a family court judge. And so when you have a business, you have income, you have expenses. And when you have business expenses, they have to be what's called ordinary and necessary. It has to be common within the industry. And so what I'm sure all of us have seen in our practices is that our clients are going to have business income and expenses, and hiding within those expenses is things that are gray or clearly not allowed. What am I talking about? Your client owns a business and the business pays for the cell phone plan for the owner and the employees. And they also pays for the cell phone for the entire family. So the 10-year-old, the 15-year-old, everybody's getting new iPhones every year. And that's just getting rolled into those business expenses. Or, your client's business is taking huge losses. They have negative income. That's great that you report that to the IRS. But when it comes to calculating child support, judges aren't going to be too happy about seeing all of that negative business income. And so one of the questions that was popped in the chat is exactly that. So when you have these issues, what do you do? What do you do? So with family law software, you're putting in the business, obviously, as it's reported, the income and expenses, so that we can calculate the taxes. But sometimes you have to do something that we call put it back. So if you are analyzing the business of the opposing party and you are seeing questionable expenses, and the spouse always knows about it. The spouse knows that the refrigerator was purchased for the house, those types of things. And so if that happens, Nancy, can we please show our users how we suggest they put it back, especially for those support purposes?
Yeah. So we very often see personal expenses run through the business. And from the IRS point of view, there may not be a problem with it. It's not necessarily illegal or improper. But for child support purposes, there may be expenses that get put back pursuant to your state's case law and statute. So I'm going to go into now, and this is Florida, so this may look a little different in your state, but we're going to go into the income and expense area of the data entry. And I'm going to scroll down in Florida. This would be in the gross income part in the second section. And for each section here, they're numbered. So I'm going to go down to section 13. And section 13 is for putting it back, reimbursed expenses and in-kind payments. So the country club dues, the automobile, the cell phones, anything like that that you're going to add back, you're going to leave it in the business expense for tax purposes, as Anna said, but you want to add it back for child support purposes. So let's say that Jason has $10,000 of um, reimbursed expenses that are coming back to him. Now we're going to add that to his income because it's been deducted from the business income. So the business income is not reflecting this amount, but for support purposes, we want to show it. So, and in your state, you may have a reimbursed expenses add back section. If you don't, then what you may want to do is put it in other income. It may be called wage-like income in your state, and we have a whole bunch of blank lines, and you can add it in here as one of the add backs in this section if you don't have a specific section in your state. Okay.
Yeah, awesome. Thank you so much, Nancy. So that's going to be the conclusion of today's webinar on family law software business income. We are going to finish answering the chat questions, but if you have any questions for any of our presenters, please email us. It's going to be support@familylawsoftware.com. That email can be used for anything. So if you are a desktop user and you would like to upgrade to cloud, that's a great idea. If you've been watching this presentation and you're seeing some of the reports, those are not included in the basic. So if you're a basic user and you'd like to upgrade, email us at support@familylawsoftware.com. And then again, if you have specific questions about the presentation or how we can improve or what we're doing great, we always love to hear from all of our subscribers. And we really appreciate your time today. This recording will be available on our YouTube channel. We are not offering credit for this course. There is no CLE, CME, CE credit. If you would like to do this as an individual study, you're going to get an email after the presentation that says, thank you for attending today's webinar. It'll link to our YouTube channel. And you can email us for the PowerPoint presentation if you would like to attach that to any self-study that you need to do. All right, thank you so much for joining us today. I'm ending the recording now and we will finish answering the chat. Thank you so much.